Welcome back to Wealth Signal. I'm Alex Carter, and today we're breaking down something that just got buried under the headlines. The new Fed chair just told everyone to stop guessing about rate cuts. That's a problem, because if he means what he says, your portfolio might not be ready for what comes next. We began this year expecting interest rates to keep falling. That was the plan. The new Fed chief, Kevin Warsh, was supposed to push rates lower, but this week's Fed meeting flipped that completely. Inflation has been sticky, refusing to come down the way everyone hoped, and this latest meeting confirmed something uncomfortable. The Fed is watching inflation closely, and a rate hike later this year is now back on the table. If that happens, it changes the math for almost every sector, especially the one carrying this entire market right now, tech. I went through the data behind this shift, the actual probabilities, the actual sector reactions, so you don't have to. If you're serious about protecting and growing your money no matter what the Fed does next, hit subscribe right now because we break this down every single day. Today, we're covering exactly what changed at the Fed, why tech got hit the hardest, and two stocks built to hold steady, or even thrive, if rates climb instead of fall. What changed at the Fed? Here's what actually happened on Wednesday. The Fed didn't announce a hike. What it did was quietly remove the language that had been signaling a rate cut was coming, and that single change reinforced the idea that a hike later this year is now realistic. The market reacted immediately. Stocks closed down sharply on Wednesday. Then, on Thursday, easing tensions around Iran helped pull oil prices back, and that gave the market a partial bounce. Warsh's actual message was simple. Stop trying to predict what the Fed will do next. Just follow the data. Easier said than done in a market that's always looking ahead. Why tech got hit hardest? Higher rates mean higher borrowing costs. And right now, the tech industry is borrowing aggressively to fund one thing: AI data centers. That means it could cost more to build those data centers. It could slow down deals getting done. And over time, it could slow how fast that spending turns into actual revenue and profit. Here's the balance, though. Tech sold off initially, but it's already rebounded, staying roughly flat for the week. The AI demand story is strong enough that tech could keep rallying no matter what the Fed does. This isn't a sell your tech stocks moment. It's a don't put all your eggs in one basket moment. The numbers behind the shift. Let's look at the actual data. The CME FedWatch tool tracks the real-time odds of a Fed move based on futures trading. Right now, it's showing about a 35% chance of a rate hike at the next meeting, roughly 45 days from now. By the end of the year, an 85% chance of at least one hike. That's up sharply from just 50% a few weeks ago. And there's now a 50% chance of two separate quarter-point hikes before this year is done. That's a real shift in the fundamental outlook, and it's exactly why diversification matters more right now than it did 6 months ago. Drop a comment and tell me, are you adjusting your portfolio for higher rates, or are you staying the course? Why diversification matters. Diversification is just smart. It spreads the risk so no single position can wipe out your whole account. It's too easy to load up on one winning trade, get greedy, add more, and then watch it reverse and take your profits with it. It's nearly impossible to know which stock will be the year's big winner, so you spread that money, some safe plays, some high upside plays, without overloading on any single sector. So, let's talk about two stocks built exactly for this kind of environment: higher rates, stickier inflation, and consumers who are getting more careful with every dollar. Stock number 1. Ollie's Bargain Outlet. Ollie's Bargain Outlet. I know, it doesn't sound exciting, but this is exactly the kind of stock most investors scroll right past. Most people lump Ollie's in with the dollar stores. That's the wrong comparison. Ollie's is closer to TJX, opportunistic, buying closeout inventory cheap and selling it at a real discount, without being locked into carrying the same items every quarter. Here's the snapshot on the business. A bargain closeout retailer with real pricing power on inventory most chains can't access at the same cost. Now, here's what's been dragging the stock down: the Big Lots acquisition. When Big Lots went out of business, Ollie's picked up a lot of those store leases. Problem is, it's been paying rent on space it isn't using yet, what's called dark rent. And that squeezed margins over the past year. But that's a near-term cost, not a long-term flaw. As Ollie's converts those dark spaces into working stores, revenue accelerates and margins start repairing themselves at the same time. And here's the part that matters for your portfolio specifically. As inflation pressures consumers, more of them get pushed toward bargain retailers like this one. That means less downside for Ollie's when the market turns lower, and a sharper bounce when sentiment turns bullish again. Before we continue, throughout this video I have been referencing visuals and frameworks designed specifically to make these ideas easier to absorb and remember. I have compiled all of them into a single visual summary file for this video. If you want to download it and keep it as a permanent reference, I have set up a Wealth Signal Telegram group where the file is waiting for you. And it is not just this video. Every video we have done before has its own file in there, and every new video we release, the summary goes into the group first. So if you want this file, and you want to be first to get every future one, the link is in the description below. Join the group, grab the file, and I will see you in there. Stock number 2, TJX Companies. TJX Companies. You know it from Marshalls, TJ Maxx, Home Goods. It doesn't get the headlines tech stocks get. It also doesn't need to. TJX isn't just a clothing chain anymore. It's the largest off-price retailer in the world by sales and market value. And right now, it's quietly taking market share away from name-brand retailers struggling with consumer headwinds. Take Nike, for example. Nike's been struggling. It shifted towards selling directly to customers instead of through retailers, which hurt its wholesale relationships and its overall reach. That's bad for Nike. It's good for TJX, because the exact same Nike shoes end up on TJX shelves at a lower price, and shoppers go where the deal is. With name-brand retailers struggling to move inventory, there's no shortage of deals for TJX to buy, and it's been buying aggressively while still turning a strong margin on every item it sells. This isn't a stock that's going to hand you 200% in a year. What it offers instead is something steadier: rising fair value over time, a dividend, consistent share buybacks, and a business model that holds up, or even strengthens, when consumers get squeezed by inflation and higher rates. If you're finding real value in this breakdown, smash that like button. It genuinely helps this video reach more investors who need to see it. If I had to rank these two for a higher rate environment, TJX first, simply because of its scale and consistency, then Ollie's, because the upside gets bigger once that dark rent drag rolls off. This isn't about abandoning tech. AI demand isn't going anywhere, and that alone could keep tech stocks moving even if rates climb. This is about not putting all your eggs in one basket, especially the most expensive basket in the market right now. This is my analysis based on the research, not a recommendation to buy anything. Your situation is different from mine. Always do your own homework before you put a single dollar into any stock. If this breakdown helped you see the Fed shift more clearly, hit that like button. Subscribe with notifications on, because we cover moves like this the moment they happen. And drop a comment. Which of these two stocks fits your portfolio better, Ollie's or TJX? And if you want the visual summary file for this video, join the Wealth Signal Telegram group. Link is in the description. I'm Alex Carter, and I'll see you in the next one.